All right, let's get started. So this is the investment policy statement that I prepared for you, and obviously it's by me, Alexander Rozas. So let's get straight into it. Here's my client's profile. He's a 30-year-old male. He's an architect. He's married with 2 kids. His household yearly income is $200,000 a year. His monthly expenditure is $5,700. His investment experience is low. And his goals are he wants to be able to put his kids through college. He wants to be able to save up enough for retirement. He wants to find safe and long-term investments along with solid short-term ones. His needs and pain points are he doesn't have the slightest clue how to invest. He doesn't want to invest in fossil fuel companies, and he doesn't mind slight losses as long as they come back to profits quickly. My client's financial goals is he wants to put 2 kids through a 4-year state college, so estimated $280,000 a year, $35K a year at the University of Oregon. He wants to put away $5 million for retirement at age 65 and is aiming to live until 100. He wants $2,500 a year on luxury items. He wants to take a 1-week vacation a year, domestic 1 year and international the next year. So for one domestic trip, it will cost $3,500, and for 35 trips, it will cost $157,500. And estimated for one international trip will cost $10,000 or $350,000 for 35 trips, and in total, it'll be $507,500. And so the total savings required would be $5,889,000. All right, so my investment strategy for picking stocks and bonds is 1, value investing, where I look for companies that had a high EPS, which is earnings per share, and a low PE ratio, which is share price over earnings per share. Then, for fundamental investing, I look for companies that made a profit or have a high 1-year target estimate on Yahoo Finance or on MarketWatch. For socially responsible investing, I didn't invest in any oil or coal companies, and I tend to choose companies that have solid rating on CDP, who rates companies on their impact on climate change. Finally, I looked at technical investing, where I tended to either steer away or be extra cautious when I saw stocks that were at their peak, and also looked at stocks that I believed were going to recover from their current low state. So for the target asset allocation, I decided to put 90% in stocks, which were 90% domestic and 10% foreign. And then I put for 9% in bonds, which were 100% federal government. And for cash was 1%, and 100% of that went to a savings account. For the investment selection criteria, I considered last year's / quarter's profit / revenue, an increasing EPS ratio or earnings per share, a low PE ratio, share price over earnings per share, a high 1-year target estimate on Yahoo, a trending upwards performance outlook, chart history, looking for stocks that are about to rebound, positive market watch predictions, high grades in controlling climate change, and companies that are widely known and have infrastructure already in place. Monitoring parameters. I have a lot of clients whose portfolios I manage. That doesn't mean that I give different treatment or rush to get everything done. I'll check at least twice a week, once on Sunday and once on Wednesday, to make sure that your portfolio is producing maximum profit. Also, I'll send you an email telling you the current state of your portfolio once a week on Sunday. Here is the first part of my investment selections. I will go over each individual investment in detail. And so for right now, I encourage you to pause the video and take a detailed look at the investment selections here. Here is the second investment selections part. I also encourage you to pause the video and take a detailed look here. As I said earlier, I will explain each one of my picks in detail. Before I get into the detailed why I picked each stock, it's important to know that each company has a scandal, has negative business practices. That does not mean that you shouldn't invest in them. Personally, when I was choosing mine, I tend to look for some that didn't have too much shady business practices, but it's pretty much unavoidable. Now that's settled, I first want to go over Adobe's cons. It has an expensive PE ratio, around 46. It's an overvalued stock on Yahoo, and it does not provide a dividend to stockholders. Adobe's pros has an increasing EPS. It has a high one-year target on Yahoo, and you see the estimated 57.53. That's how much they believe it'll grow. It has a 17.97% increase in profit in the last reported quarter. Its climate score on CDP is an A, and it provides Adobe Spark free to students. I believe Adobe's high potential to grow and positive climate outlook outweighs their cons. Okay, going next for Allstate, their cons is it was not rated the best company to work at, and that's pretty much it. Looking over Allstate's pros, you can see they have an increasing EPS, they have a cheap PE ratio, they're undervalued stock on Yahoo, they have a good one-year target on Yahoo Finance, obviously not too high. They made around a 5% increase in profit, they have a 2% dividend, and they got a climate score of A on CDP. This is why I believe that Allstate is one of the best investments since there's little to no cons and there's a mountain of pros. Alphabet or Google's cons is they have an expensive PE ratio, they don't give out a dividend, and they've had a large amount of criticism going with tax avoidance, misuse of search results, and accusations of spying. Alphabet's pros, you see they have an increase in EPS, they have a high one-year target with 100 plus, they have around a 9% increase in profit in the last quarter, they have a climate score on CDP, which is an A, and they already have a solid infrastructure. That means, they're a big company, and that's why I think because they're a big company and because they seem to be going to be increasing in the stock price, I think that's why we should invest in Alphabet. Going with Amazon's cons, we can see that they have a very expensive PE ratio. They don't give out a dividend. Yahoo thinks they're overvalued stock. Their climate and forest score on CDP is an F, and they don't always treat employees well. And that is a good amount of cons, but I want to get over to the pros. What makes up the difference with Amazon is their pros. They have an increasing EPS in shares, which means the overall number of shares they give out. They have a high one-year target on Yahoo, so around 650 plus from the current state right now. They made a 36% profit in the last reported quarter, and they're a big company. And I think because of that high potential for growth and how big Amazon is, I think that overweighs the cons, and I believe they are a good company to invest in right now. Now going to Apple, we see they have a lot of cons. They have a varying EPS, they have an expensive PE ratio, they have a decrease in one-year target on Yahoo, they're an overvalued stock according to Yahoo, they have a F4 score on CDP, and they secretly slowed down their old phones. Going over to pros, we see why I chose this. They did make a 1.5% profit, but the real reason is because they have a really good high short-term and mid-term outlook, which means they'll make a lot of money right now. They also do provide a 0.6% dividend. They do have an A climate score, and they are a big company. But because they're going to go up right now, this is why this is one of my short-term investments. All right, now to Bio-Rad Laboratories. The Bio-Rad cons is that they are an overvalued stock on Yahoo. They don't provide a dividend, they don't give climate data, and they're not a large company. But those altogether aren't very big cons. We can see that Bio-Rad Laboratories pros make them a good pick because they have a increasing EPS, they have a cheap PE ratio, they have a high one-year target on Yahoo, which means right now they're projected to raise 85 points, and they have around a 20% increase in profit in the last quarter. And that's why this high room for growth is why I think we should invest in Bio-Rad Laboratories right now. With CVS Health, I wanted to do something a little different and start with their pros. They have an increasing EPS, they have a cheap PE ratio, they have a decent high one-year target on Yahoo, around 14 to 15 points. They have a 7% increase in profit in the last reported quarter. They offer around a 3% dividend. Their climate score on CDP is an A, and they're a very big company. With as much as CVS Health has pros, they have their fair share of cons in that they have a C4 score on CDP. They paid $790,000 to settle an opioid crisis case. They bribe politicians and doctors and participate in health fraud and shady business practices. I understand that CVS Health's cons can be a turnoff, but I believe that because one, they're one of the better pharmaceutical companies, and two, that they have a room for growth, that I think we should invest in them, though I don't think we should invest much in them, but I do believe that it will be a worthwhile investment to put your money in. Going over to one of my better findings is Graham Holdings, and we see their cons is they have a fluctuating EPS. They are an overvalued stock on Yahoo. They don't provide any climate data, so we don't know how good they are, and they are not a large company. But Graham Holdings pros are very good. They have a cheap PE ratio around 13. They have a high 1-year target on Yahoo, which is around 86, but it has gone up to around 150. They have an 8% increase in profit in the last reported quarter, and they provide a 1.1% dividend. And I think that room for growth is why we should invest now instead of later. Now moving on to Intuit, you see they have 4 cons. They have an expensive PE ratio, around 50. They're an overvalued stock on Yahoo. There's no climate data on them, so we're not sure what their score is. And they're trying to pass a law that would ban the government from just doing your taxes for you. Moving on to Intuit's pros, you see they have an increase in EPS. They have a high 1-year target in Yahoo, around plus 22. They post a 22% increase in profit in the last reported quarter, and they provide around a 0.6% dividend. And I think that room for growth is the reason why we should invest in them right now. So now looking at Microsoft, we see their cons is they have an expensive PE ratio. They're an overvalued stock on Yahoo. They have ties to the NSA and ICE. They've had several copyright, labor, and privacy issues. Now moving over to Microsoft's pros, we see they have many. They have an increasing EPS. They have a high 1-year target on Yahoo, around 18.5. They made 15.5% increase in profit in the last reported quarter. They provide a 1% dividend. Their climate and water scores were an A, and they're a big company, so they have a very solid infrastructure. Because Microsoft has a lot of room to grow, positive climate ratings, and they provide a dividend, I believe that those factors alone outweigh the cons. Now going over to one of my favorite businesses, Netflix. We see that they do have several cons, and that they have an expensive PE ratio, around 83. They don't provide a dividend. They're an overvalued stock on Yahoo. Their climate score on CDP was an F because they did not provide a response. And the shows can be kind of controversial. Now moving over to Netflix pros, you see they have an increasing EPS, around 6. They have a high 1-year target on Yahoo, so around plus 35. They made around 20% increase in profit in the last reported quarter. They're a big company, so have a solid infrastructure, and their product right now is in large demand due to the pandemic. Because a lot of people are using Netflix right now, I think it would be a good investment until at least the pandemic is over, because since a lot of people are stuck inside, they need something to do, and Netflix is one of the most popular pastimes. Moving on now to one of the more favorable companies, we have the Renewable Energy Group, and we see they only have 2 cons. They have a decreasing 1-year target on Yahoo, which is around minus 0.3, and they do not provide a dividend. Now moving over to the pros, you see those heavily outnumber the cons. They have an increasing EPS. They have a cheap PE ratio, around 5.6. They're an undervalued stock according to Yahoo. They made a profit, and the Renewable Energy Group provides a clean alternative to fossil fuels. And I think just because of their positive impact on the climate, it's worth investing in them. Now going to a fourth company, we have Toyota Motor. Their cons are they have a declining EPS. They have a 14.4 decrease in profit in the last reported quarter due to the fact that less people are buying cars. And their forest score on CDP is an F. Now moving on to their pros, we see they have a cheap PE ratio. They have a good 1-year target on Yahoo, around plus 19. They provide one of the highest dividends in 2.77%. They have a climate and water score on CDP, which is an A, and they're a big company, so they have a solid infrastructure. When this pandemic is over, people are going to be able to afford to buy more cars, which is going to result in the stock price going back up. And also, they provide a really good dividend. So I think those are some of the reasons why you should invest now, because Toyota Motor is most likely going to recover. Next, we have the United Health Group. You see there are 2 cons in that their algorithm was accused of racial bias, and they wrongly retained more than $1 billion in Medicare, which I will say are 2 very big cons. Moving over to the pros, you see they have an increase in EPS. They have a cheap PE ratio, around 19. They have a high 1-year target on Yahoo, around 44.5. They posted a 6% increase in profit in the last reported quarter. They provide a 1.5% dividend, and their climate score on CDP is an A-. Though they do participate in shady business practices, I think that high one-year target GPE ratio and 1.5% dividend is a good enough reason why to invest in them right now. Now going to the only bond pick where I put all of it in the U.S. Treasury, and the only con I could see is the price of the bond has been steadily going downwards, but this has been over decades, and it goes up and down over years and obviously the state of the economy. Moving over to the pros, they see that the price will rise when the U.S. economy recovers, especially from this pandemic, so it's a good time to put in money now. The U.S. government is one of the safest places to put your money, and they can print more money to meet their financial obligations. And if the U.S. goes bankrupt, we have a lot bigger problems than your portfolio. Because of how safe it is to put your money into the U.S. Treasury, I think it's a good idea to do that now, especially since the price is low and will most likely go back up. And this is kind of will serve as a safeguard because it is such a low chance that you lose any money here. All right, final pick is a savings account. The savings account, we can see their cons is that you don't make much money when you put in your investment, and you can lose money if the interest rate doesn't keep up with inflation. With the cons in mind, it's important to know that a savings account is a safe place to store your money, and it's actually very low risk that you're going to lose money. And I decided to put in the rest of the money that has not been invested into a savings account for safekeeping. All right, let's do a quick recap. My client is a rookie male investor who wants to save money to help pay for his kids' college, vacations, and retirement at age 65. My investing strategies consist of value investing, increasing EPS/low PE ratio, fundamental investing, making a profit/high projection, socially responsible investing, low impact on climate change, technical investing, stocks expected to go back up, and investing in companies that have a solid infrastructure already in place. The target asset allocation will be split up into 90% stocks, 9% bonds, and 1% cash. I will check up on your portfolio twice a week and send you a report once a week. Finally, I invested in Adobe, Allstate, Alphabet, Amazon, Apple, Bio-Rad Laboratories, CVS Health, Graham Holdings, Intuit, Microsoft, Netflix, Renewable Energy Group, Toyota Motor, United Health Group, U.S. Treasury, and a savings account. That concludes my presentation, and I would like to thank you for your